Welcome back. As we jump back into the study of ethics after our extended spring break, I thought we'd go back to the basics. How we get from corporate decisions to laws to ethics, up to and including accounting ethics. So from your reading, the TLDR of it all is that ethics are what happens when good governance goes bad. In this lecture, we'll be covering the concept of governance, and we'll be deriving it from agency theory, an important concept from finance management, accounting, really all of the disciplines. We'll discuss the business ethics emergence cycle. Now, the business ethics emergence cycle, something that wasn't explicitly discussed in your reading, but the authors implied the process pretty strongly. We'll then apply the business ethics emergence cycle using examples from Enron, Arthur Andersen, and the resulting Sarbanes-Oxley Act of 2002. Since the ethics emergence cycle ends with ethical decision making, we'll look at stakeholder view and then discuss how thinking more broadly than just your stockholders can help improve your ethical decision making. The textbook's reading discusses the need for corporate accountability and how this idea evolved over time. As you saw in your reading, there have definitely been some periods where corporate accountability has been held in more importance than others. It wasn't until the 1970s that stakeholders and stockholders began to push for better treatment. One of the popular theories to emerge during that time period was Jensen and Meckling's agency theory. This is a famous paper that derives the concept of governance as well as the need for governance. So to illustrate it, I've prepared a little vignette. This is a manager of a sole proprietorship. He's responsible for making decisions on behalf of the business. Every expenditure, every revenue dollar that comes in is under his direction. Therefore, he retains all business profits. Whether he maximizes profits or minimizes profits or aims for somewhere in between, it's all under the purview of the manager. So let's say in the future he wants to grow his business. He has the option of obtaining a business loan, which carries its own risks, taking on partners, or to raise a lot of capital quickly, he can sell a portion of his business to shareholders. The shareholders provide him with cash in exchange for a portion of the business ownership. In an ideal world, he uses the equity financing to grow the business, and he returns to the shareholders a portion of profits, either dividends or share value growth. But the manager could also spend the money on perks for himself. Now that he's no longer in charge of setting the profits, and he has to share the profits with other people, there's a bigger temptation to expend the company's funds on things that would benefit him. Things like cushy office furniture, like Ben Carson did, or attractive secretaries. And for the record, both of those examples were included in Jensen and Meckling's famous paper. The shareholders don't like this. The shareholders want the company to maximize their profit. They want to see their share price rise and or receive dividends on their investment. So they elect a board of directors to help keep an eye on the manager. We've seen this slide before in our previous classes, but I like it because it shows the dividing line between oversight and action. Governance provides the structure to keep an eye on management, generally the chief executive, the CFO, and the other executive team, who then make decisions on behalf of the company. Sometimes that oversight isn't enough, though. And the board of directors knows that they can either watch the unscrupulous manager, for lack of a better word, piss away their corporate profits, or they can spend that same money on governance mechanisms to try to keep those profits in the company. Popular governance mechanisms include the internal control system, the external review by an independent auditor, and a compensation structure that rewards desirable executive behavior. This is usually in the form of bonuses, stock options, things like that. Things that tie the company making money to the shareholders making money. But as you saw in the reading, this can also have undesirable effects. The chapter ends with the 7 signs of ethical collapse. And each of the first 4 have to do with management, as well as a governing board that lets the management do what it wants. This is why aligning profits with management behavior is not always the most ethical decision. So the textbook alludes to this cycle where ethical behavior evolves. It starts with a growing awareness of problems, things that cue employees and outsiders into the fact that something is going on. It's followed by a crisis of confidence. Something goes wrong, indicating that the ethical problem is not just perceived, it's real. And the textbook presents multiple examples of this. When it gets bad enough, our government steps in to set legislation and regulations, as well as expectations. And finally, with the new push to law, encourages people to be more ethical, to behave at a higher level, and to do better. And this timeline lays out in chronological order some examples of this cycle in action. You've got the clue that something's wrong, followed by a corporate governance failure, followed by a law, over and over and over again. And to illustrate the cycle, we're going to look at 2 examples and the resulting law that followed. Enron, which up until WorldCom was the biggest fraud of its time, the complicit auditor, Arthur Andersen, and the resulting law, the Sarbanes-Oxley Act of 2002. We could examine the Enron case from every angle. I really like this graphic that shows what went wrong. One of the things that went wrong was Enron's process of recording revenue. They petitioned and were allowed to record cash receipts as revenue for the long-term energy futures contracts that they sold. Revenue is supposed to be matched with the periodic expenses that go into earning that revenue. So when someone bought an energy futures contract from them to cover a multi-year period, Enron instead was recording all of the revenue right then and there, which meant that in the year of receipt, their revenue was inflated. The more complex fraud that went on at Enron had to do with these special purpose entities. You've got the parent corporation Enron, who is trying to sell long life assets. When they couldn't find long life asset buyers, they decided instead to create unconsolidated affiliates called special purpose entities to serve as investment vehicles. Enron sold these long-life assets to the SPE, and then the SPE transferred cash to the Enron parent corporation, and Enron recorded revenue from a result of that transaction. The banks who were dealing with Enron kept funneling cash into the organization. In the end, what was left was a shell game. You see on that table in the bottom left-hand corner that bank financing from outside lenders far exceeded the non-cash financing that these SPEs were actually able to provide. And over time, Enron simply couldn't keep the shell game up. So then you have Arthur Andersen, Enron's auditor. They're supposed to be following these transactions and making sure that Enron is complying with generally accepted accounting principles. Andersen started out a pretty upstanding guy. Arthur Andersen, the man, founded the company in 1913 and grew it to become one of the 5 largest accounting firms in the world. Those revenues that fueled its growth came from both accounting services and consulting services. And by 1984, the consulting revenue exceeded the revenue that was received for accounting and auditing services. Eventually, the consulting branch of Arthur Andersen spun off into its own entity called Accenture. They're still around and they're still very profitable today. But Andersen, the firm itself, got used to those big $5. So they wanted to keep earning big $5. And to keep earning big $5, they had to find a way to replace that revenue that they lost from the consulting branch when Accenture split off. They did this through linking employee promotions to finding new sources of revenue, pushing non-audit services to client management, including telling clients how to structure their transactions, and cutting costs, and ultimately cutting corners on audits. Enron and Andersen fell victim to a number of governance failures. Enron's board of directors were unaware of what was going on in the company, were incompetent and lacked financial expertise, and were conflicted. A number of them had financial dealings with companies that directly interacted with Enron. In addition, the external auditors were also conflicted. They were willing to do whatever it takes to keep the Enron money flowing, the non-audit services flowing into Enron from Enron exceeded the audit services fees. Within the Enron organization itself was an emphasis on winning the deal, epitomized by the behavior on the trading floors and the manipulated prices of energy. It also was a culture that espoused silencing whistleblowers and doubters. Both Enron and Andersen had people who stood up and said something's not right, but their voices were not heard. In the end, the tone at the top at Enron was one that discouraged ethical behavior and encouraged deception. As a result, this led to massive consequences on the global scale. Enron went bankrupt on December 2nd, 2001, and tens of thousands of employees lost their jobs. Enron investors were misled, including many employees of Enron who had invested in shares of stock in their pension plans. 10 Enron executives were eventually found guilty and charged for their fraudulent involvement with the company. But more globally, the Enron, Andersen, and the other contemporary frauds led to a loss of confidence in the stock market, a loss of confidence in the audit profession, as well as new regulations imposed on the audit profession. This brings us to the Sarbanes-Oxley Act of 2002, the third phase of that ethical scale. Sarbanes-Oxley brought changes for regulators by creating the Public Company Accounting Oversight Board for the auditors, who now had to examine the internal control structure and who would report directly to the audit committees. It created an audit committee, so a separate governance arm specifically charged with overseeing the audit process for management, who had to sign off on the financial statements on a quarterly basis and develop and maintain an internal control system. And for internal controls, which now became the focus of companies in promoting financial reporting, accuracy, timeliness, and relevancy. So let's take a quick check of your comprehension and talk about what SOX meant. When Congress passed SOX, it imposed greater regulation on public companies and their auditors and required increased accountability. Which of the following is not a provision of the Act? And I'll give you about 5 seconds to think about that. The answer is D. Executives are required to certify the fair presentation of the financial statements. They do this quarterly and annually. And by certain executives, we mean the CEO and the CFO. It requires management to establish and document internal controls. It created the Public Company Accounting Oversight Board. And it did add enhanced responsibilities for the audit committee, including the inclusion of a financial expert. But the audit committee must be comprised of entirely independent officers, meaning they cannot be on the payroll of the company. This brings us to the final phase of the ethical development process. How do you ensure that your employees carry out the ethical responsibilities they owe the company and the shareholders? The authors make a plea for consideration of stakeholders because profit isn't everything. We saw a couple of examples in the textbook of how stakeholder and shareholder advocacy really drove the changes needed in the marketplace. So we're going to spend a little bit of time talking about the difference between shareholders and stakeholders, and then talk about what that means for ethical decision making. To know what a stakeholder is, you have to know what a stake is. A stake can have multiple meanings. It can be a claim to the firm or an ability to influence the firm. It can be the possession of an established relationship with the firm. And it can also be someone who has urgent dealings with the firm. A popular paper on stakeholder theory, published by Mitchell, Agel, and Wood in 1997, gave these 3 monikers: power, legitimacy, and urgency. The first 2 groups, those with power and those with legitimacy, have more say on what goes on in a company than those who merely have an urgent claim. And let's take a look at what each of those things mean. A stakeholder who has power over a corporation is one who can get a corporation to act in a certain manner, something that the corporation would not have otherwise done without their influence. This can be the government. The government, although it's not a direct player in the corporation's profit earning relationship, it can set the laws and get a corporation to do things that it wouldn't otherwise do. A legitimate stakeholder is one who has something at risk, generally carried out through a contractual relationship. This can be a customer, it can be a supplier, it can be a lender, it can be a debtor. People who have a contractual relationship and a need for that business to survive. The third claim is urgency. This means that the stakeholder needs the corporation to do something immediately, but needs the corporation to do something critical. This can include those who live in the city in which the corporation does business. They have an interest in what the corporation does, but they're generally not powerful in and of themselves, and they generally don't have a legal claim against the corporation. It can also include the public media. For example, most corporations don't want to end up on the front page of the Wall Street Journal for doing something bad. While the Wall Street Journal doesn't have power or legitimacy over a corporation, their position can make them get the corporation to do something that they might not otherwise do. So then we brought our Mr. Manager back with his stockholders and with his board of directors. Under stakeholder theory, the manager realizes that there's more to life than earning a profit, and he recognizes a need to care for those outside the stockholder relationship. It means that Mr. Manager looks to his stakeholders in making decisions, and the stakeholders provide feedback to the manager. They also can interact directly with the board of directors. When all of these parties are considered, it makes a difference. He's not going to do something that's going to land him on the front page of the Wall Street Journal. He's not going to destroy the planet because he knows he needs the planet to do his business. And he's going to try to do right, not just by his stockholders, but also by all those who are impacted by his firm's decision. And when you make your decisions based on the global good, you tend to think more ethically.